Tired of stressing about money? Your business is making money, but somehow you still feel broke? And you're not alone. Most business owners are doing one thing wrong. And surprise, surprise, the ultimate sign of a healthy business is not just measuring revenue. It's what you do with the revenue after it's actually in your account. Hi, I'm Brad. As a CPA, I've spent years analyzing the cash flow of businesses. I see a pattern with those that scale rapidly, and in this video, I'm going to share those businesses' expertise. By the end of this video, you're going to have a clear plug-and-play plan to pay yourself more, to save enough for taxes, and never worry about surprise cash problems ever again. But first, let's set a healthy finance mindset, because here's the truth. Making money is just the beginning. What you do with the cash generated in your business is what separates struggling businesses from successful businesses. Let me guess what's happening in your business right now. You get paid for a project or a sale. Maybe it's $5,000, maybe it's $50,000. And for a moment, your bank account looks great. You feel on top of the world. But then reality hits. A client project gets delayed. You get a chargeback from a major sale. An unexpected purchase pops up, or tax season sneaks up on you, and suddenly the money's gone. You're left wondering, how am I making all this money but still feel broke? Here's what most business owners get wrong. They treat their revenue like a paycheck. Money comes in, goes out. Simple, right? But your business isn't a job. Your revenue is not a paycheck. And think about it. You're not just an employee. You're the CEO, the sales department, the finance team, and the operations manager all rolled up into one. Your money needs to serve all those roles too. That's why today I'm going to show you the revenue router system. It's a system I teach to business owners who are tired of feeling broke despite making good money. Let me show you exactly how successful businesses manage their money. We're going to use percentages of your annual revenue as a guide, because whether you're making $100,000 or $1 million, these percentages work. Every dollar that comes into your business needs clear directions. Just like a GPS won't start routing until it knows its destination. Your money needs to know where it's going before it hits your account. So let's start with two numbers you need to know about your business. First, your annual revenue. Take your best guess. Write that number down. Second, multiply that number by 10%. That's your minimum operating balance. Why 10%? Because that's your business's fuel tank. Just like you wouldn't start a cross-country road trip with an empty tank of gas, you don't want to run your business on an empty operating account. Now, some businesses might need more like 30% for business operations. If there's partners wanting to be bought out or there's too much risk concentrated in one major client, 30 might be more appropriate, or somewhere in between. But to keep it simple, let's start with 10%. You can always adjust up later. Now, let's talk about what happens when money actually hits your account. I want you to imagine you got paid $10,000 for a project. The moment that money hits your bank account, we need the perception of two things happening. First, check your operating balance. Remember that 10% annual revenue number you wrote down earlier? Are you at that minimum? If not, this new money needs to help fill the tank up first. Second, go to your profit and loss statement. Take 30% of your profit loss and move that into your tax savings account. This isn't negotiable. Everybody's got to pay tax in the United States. And here's where things get interesting. Look at your operating account. Ask yourself one simple question. Do I have that 10% minimum? Every extra dollar needs to go to that savings tank until you get to it, period. If the answer is no, make sure you think about what you really want to do with that money, because it should be going to fill up the tank of the business. Let me show you why this really matters. Last year I had a client. Let's call her Sarah. Sarah was making $400,000 in revenue in her business, but constantly stressed about money. Why? Because she was running on empty. She only averaged about $5,000 in her bank account at any one time, always meeting bills at the last minute. That's like starting out your trip across country with only a gallon in the tank. It's not going to work. Once you've hit your operating minimum and set aside money for taxes, you've reached what I call available cash. This is where things get exciting. Available cash means exactly what it sounds like. It's available for you to direct where you want it to go. You're not robbing the tax fund. You're not running on empty. You've taken care of the basics. But here's where most business owners make a mistake. They see available cash and they think, this is all the money I can take home. Hold that thought. Before you distribute everything to yourself, you need to think about CAPEX. That's short for capital expenditures. In simple terms, I use it as the big stuff your business needs. So ask yourself, in the next 3 to 6 months, are you going to need new equipment, major software upgrades, office renovations, training programs? Is your office roof in terrible shape? Whatever your business needs to grow, this is where that money comes from. And here's the key. You set this aside before you decide how much money you want to take home. And let me show you how this works with real numbers. Remember Sarah? Once she started setting aside money for CAPEX, she was able to upgrade her entire client management system. without touching your operating account or stressing about the cost. That's the power of cash routing. Now we come to the moment you've all been waiting for, distributable cash. The money you can actually take home. This is what's left after operations are at the minimum, you've set aside money for taxes, and you've planned for your CAPEX. This is truly your money. You can take it home without that voice nagging in your head, wondering if you should have saved it for something else. And here's the beautiful part. When you follow this system, the amount is usually higher than what most business owners pay themselves. Why? Because you're not constantly dipping into your money to cover surprise expenses or tax bills. Okay, let's run through a real example one more time. Say you're making $300,000 a year. That means your operations are at a minimum of $30,000. Every time money comes in, you run it through your profit and loss and take 30% of that and save it towards taxes. But once you have above $30,000 in your operations account, you can start planning for CAPEX. Everything else after that is available for distribution if you choose. But that's just the first step. Remember the profit and loss I just talked about? To truly understand your business's health, you need to be able to understand financial statements. Don't worry, even if numbers aren't your thing, I've got you covered. I made just the video for that. Watch next.